All right, welcome back here to Trader Minute. Great to have you aboard. Let's go take a look at some things that are going on in the market. In general, this morning I chatted that there's not a lot of signal reversals, meaning things that were bullish aren't really turning bearish, and things that were bearish aren't really turning bullish. What do I mean? Well, Halliburton. Which is, we just got done talking about our position with Halliburton. It's not like Halliburton is going from a bull position to a bear position. It's still in a bullish position here. Something like Amazon. It's still in a bullish position. Something like Micron. It's still in a bullish position. But then you have things like Clorox, okay, or Colgate Palmolive, right? It's still in a bearish position, okay. Hershey, still in a bearish position. The Verizon that we talked about the gravestone on yesterday, still in a bearish position. So things that were bearish are continuing their bearishness. Things that were bullish are continuing to be bullish. They're not having signal reversals, but they're not having the major rallies as the market is down. Okay, things like things like LinkedIn that started to show weakness yesterday. Continuing with some of that weakness. Tesla, not really, but it wasn't really showing a ton of weakness yesterday. I still think Tesla, we get a move above 150, sets up for a fantastic buy. But overall, we're not seeing a lot of switches. Visa. Visa yesterday had a gravestone just like Verizon. Well, what's the difference? Well, Verizon's been in a downtrend, Visa's been in an uptrend. Nobody cares about the gravestone on Visa yesterday. Everybody cares about the gravestone on Verizon yesterday. Okay, so all in all here, we're not seeing all the same signals work, but Visa was still in a bullish position going up. Verizon was still in a bearish position and going down. There are a few switcheroos. Cisco. I believe Max, you mentioned Cisco. Cisco kind of trying to set up a little bear trap here, right? Cisco's earnings were troubling. It's now had that consolidation, the drop, snapping back. Would love to see snapback on volume here for Cisco. But Cisco is in a decent valuation point right here. The earnings missed and whatnot, but they weren't drastically bad, like some other things that were out there. So Cisco here, 20 and a half. If you want to be a buyer of it, to be buyer here at 20 and a half sets up pretty well overall. Let's take a look here at a couple others. Apple. I know a few of you are in this trade, some in calls, some in puts. Overall, like I mentioned with Apple, there's just nothing to react to here for me with it. There's just not anything there. Max, go back to Cisco here. You mentioned Cisco with huge cash, is nice cash flow, buyback is coming. Yes, there are some rumors of that, and we're seeing major buybacks announced. Boeing, big old buyback announced today. I mean, Deere not too long ago with a big buyback announced. We have companies like Caterpillar with major buybacks in play right now. That's kind of becoming the popular thing in the market. Is we're not seeing real revenue growth within a lot of these companies. They're defending their stock because, let's face it, one of the things all these companies had to do after the financial crisis is they had to clean up their balance sheets. And their balance sheets in general are very strong, and they can take on debt. They can go out and take on debt in order to buy back stock to keep their shareholders happy. Is that something Cisco could do? Sure. Absolutely, is something they could do. Apple has a buyback in place. It's becoming the popular thing to do out there for CEOs that really need to defend their stock, and so that definitely is something that Cisco could do. But you're talking even things like Honeywell, right? With large amounts of cash. that are able to do things like that. Yeah, Cisco more likely to fire employees and buy back stock. Cisco has more of that rep. But then we've heard both out of Ford and GM this week, from both these companies that they're going to be hiring more. And there's a mix there. Okay. All right, let's. So we have things that are bullish, things that are bearish, and kind of going on their merry way here, trying to figure out where they want to go ahead of the Fed tomorrow. Think about the Fed tomorrow. Traders, investors, they look at it differently. The Fed is generally a long-term type of a thing. They're creating a long-term bias, up, down, sideways. Since the financial crisis, the markets have been much more reactive to the Fed, meaning they're going to move a lot more when the Fed speaks. But during 2013, some of that's come off. 2009, 2008, even 2007 at the market tops, when the Fed would start to talk, we would see 30, 40 point moves in the S&P. And that was when the S&P was 60% of what its current value is now. We would see major moves on any sort of Fed speak. One of the things that's happened in 2013 is that the volatility around the Fed has shrunken dramatically. Okay, it has gone down tremendously. When the Fed talks, and back here when Bernanke testified in front of Congress back here in May, and we saw the market reverse and have a 30-point reversal, it was like, oh, wow, this is huge. Well, these were normal. Okay, these were very normal back in 2012, 2011, 2010. And what's happened is, as the Fed has spoken since May here, the reactions have become more minor and more minor. They've not had the same amount of volatility to them. Uh, while yes, it may seem volatile compared to what the markets have been, this year, it's not volatile in the last 5 years context. So what does that mean? Well, hey, we don't necessarily have to have a big move tomorrow. Okay, we don't have to. There are some bullish and bearish arguments about there. Now, whether you believe Carl gave some good numbers about expectations for tapering, but it's one thing to say, okay, the Fed's going to taper or not, and to get past that argument, is the Fed going to taper? We could go chase our tails all day and run around in circles trying to figure that out. It's another thing to say, what's the reaction going to be to tapering? Is a taper bullish or bearish? Well, the first time Bernanke really hinted that taper was going to be a realistic possibility was back here in May. Okay, when he was testifying in front of Congress, some people say he slipped, messed up his words. Others, like myself, think he chose them very carefully and was just trying to see the market reaction. But overall, taper talk has sent the market higher. Okay, that's the fact. Since taper has been discussed, the market is higher. Okay. Now, is that because tapering keeps getting pushed off? Is that because of other factors? But during this whole time, interest rates have been rising, taper talk has been growing, and the markets have still been going up. Okay, that's the facts. Now, the bulls will argue and they will say that, hey, pulling taper off is actually a good thing. That shows that, hey, the economy is ready to kind of stand on its own 2 feet a little bit better. We're just kind of in the initial stages of a recovery. And while, yes, it's taken 4 years to kind of dig ourselves out of the financial crisis, the market is just on its way for a strong cyclical recovery to where we get economic data to the likes of what we saw in 2006 and 2007. Okay, that's the bullish argument. They look and say, taper, great. That means more money for the banks. Great. That means less intervention from the Fed. That means more, supply demand and more asset allocation that's more correct. Okay. The bears look at it and say, well, the only reason the markets have gone up is because of Fed easing policies. The only reason the markets are high is because the Fed has basically killed the other asset classes and forced people to be buyers of stocks. That's the only reason why the market's up. If the Fed's going to step away, then there's really no floor for this market. We will start to see a contraction and erosion come into these markets to where the data will deteriorate, and without the sustainability of the bond buying program, you know, things are going to fall apart. Okay, those are the arguments that are out there. You can, obviously some of you are going to take one side, some of you are going to take another. For me as a trader, I don't care. Give me what the charts are showing me and where I need to set my positions up. I do think, though, overall, that if the Fed tapers, that long term, that's actually a good thing. It may cause some short term selling, but long term, that's actually more positive than if they keep tapering, or excuse me, if they keep the bond buying program in place. I'm more of a free market, laissez-faire, let it be. We don't need all the manipulation. Yes, there'll be corrections and volatility, but in the long term, it'll be better off. But now keep in mind, even with all this bond and Fed and taper, the Fed isn't doing this in a vacuum. I mean, Europe has incredible monetary easing policies in play. Japan has huge policies in play to try to ease monetary policy, to try to stimulate the economy. China has large programs in play. Australia, around the world, other countries have similar programs in play. And so the U.S. isn't doing this in a vacuum, and it's not anything $10 billion. If they cut and taper by $10 billion, that isn't really a big deal from just a pure money standpoint. Now, reaction standpoint, it could create something bigger, but overall, in the context of the global market and the global economy, it's not that great a deal here. So we'll be interested in the reaction. Now, is the reaction going to be severe, or is it going to be more tempered? Okay? Is it going to be severe or more tempered? Well, overall, we've seen the reactions to the Fed become more and more tempered as the year has gone on. Okay, the overall volatility around the Fed has been much less in recent months. Okay? What does that mean? Well, if we're going to set up a straddle, okay, and let's go price some straddles here. Let's just take SPY. Okay, let's just take the S&P 500, and let's go take a look at setting up a straddle and what the market is pricing in as the cost. Okay, and let's just take it. If you remember from yesterday, we talked about pricing these straddles, and you take what you buy, the price of the call, the price of the put, add them back together, and that's about how much movement you're going to have to get in order to simply break even. Okay, so I'm looking at the December options that expire on Friday. So we're not talking about a lot of time decay. We're talking about a lot of implied volatility more than time decay. And let's just say we go do the 178. Okay, the 178 straddle where we buy the 178 calls and the 178 puts. In all, we're paying $1.44 plus $1.62, so about $3, right? We're going to pay about $3 to get into an SPY straddle around the 178 strike. That means we need about a $3 move in the SPY. Okay, just doing the simple math. Can we get a $3 move in the market? Is that possible? Can the S&P move $3? Okay. Well, you're talking about the S&P on the downside having to come down to 175.5. Okay, come back down to the November lows, and on the upside, it has to go back up and break new highs. Okay. If you believe that is possible with the Fed and with the movement on the Fed, go for it. Okay, go for it. But your danger here is that if we don't get that strong reaction, that basically you're going to lose on the call, you're going to lose on the put, and you're just going to have a huge shrink in value for those options. Okay, for me, expecting a 30-point reaction on the S&P 500 tomorrow is a little tough. A little tough to imagine. Not that it can't happen, but we didn't even see a 30-point reaction in September on when the taper was supposed to happen. We didn't see a 30-point reaction on that day. Now, did we see a 30-point reaction going forward? We did. But if you're going to do a straddle expecting a 30-point reaction going forward, you basically need to come out longer, buy more time, and if you're buying more time, look at the cost. If we just go to January, we're now talking about $2.70 for the calls, $3 for the puts, $5.70. We need a 57-point move on the S&P 500. Can that happen? Sure, but that's just a break even. 57 points just to break even. In my opinion, they are priced pretty high. These options are pretty expensive for the quote-unquote expected move here ahead of the Fed. And as I go into various asset classes, I go into the small caps. Okay, we can go into the small caps here. We do the similar types of pricing. If we go out to January 110, we're looking at $4.70, $4.80. So we would need the IWM to move, almost $5 to break even. Okay, that's break even. I need this thing to go to 106 and a half, and I need it to go to 116. That's just to break even. To me, that's hard to stomach. That's hard to really want to step in. Now, Richard, you bring up a really interesting point. You say, could we straddle and place a 50% stop on each side so it's more like a $1.50 risk? Yeah, you could do that. Okay, and anytime we talk about doing something, creative like that, the thing that I ask is, what's the risk? Okay, well, what tends to happen on the Fed day? Well, on the Fed day, we tend to get on a minute chart where basically we're flat into the Fed, and then we get a reaction up and a reaction down and another reaction up, and we get these reaction highs and reaction lows. Okay, sorry for my rough drawing, but we get these reaction highs, reaction lows. So if we're putting in a stop on one side, the danger is that we come down, okay, we end up getting stopped out of our calls right down here. Now we get that next reaction up, we get stopped out of our puts up here, and, we're just, it kind of in the same spot. We don't have the straddle really playing for us. So if you're okay and willing to accept that risk, sure, go for it. But that's where the risk is. The risk is there. Okay. Now, Slavik, you bring up a good point. Or do we short a straddle and go way out with strikes? Okay. So we can, instead of buying the call and buying the put, okay, instead of buying calls and buying puts, let's talk about selling calls and selling puts. Okay, let's go to the SPY. Let's just say, you know what? We're not expecting a huge move in the market. So let's go do something like let's sell the 178s on the January strike. All right, if we do that, we're going to get, what, $5.70 in our pocket? Okay. Where do we lose? Where do we lose? Well, we lose if the market moves more than 57 points by expiration in January. That's when we lose. Okay. If you're willing to accept that risk, fine. I don't really like that risk simply because if something weird happens, we get a 100-point move, a 200-point move, you don't have any real protection. You're naked. You're naked short a call and a put in any real crash 20% type move. It's going to be crushing. Okay, instead of doing a short straddle, I'd rather do something like an iron condor if I were looking to take advantage of a potential flat reaction. So come out here and do something like where I sell the 180 call, but I buy the 181 call to offset that. Okay, so I'm collecting premium, and then do something similar on the put side, where I'm setting up a credit spread where I'm collecting premium. Now I'm collecting premium on both sides of the equation. Okay, if the SPY goes flat, I'm good. I make premium on both sides. If it does make a major move, at least I only have a little bit of risk on this side, and that's offset by some of the premium I collected on the call side, and it kind of allows for a little bit safer way to play that, instead of playing a short straddle. Okay, but it really just comes down to, comes down to preferences. Okay. Preferences. Yeah, Max, if you don't mind paying more commission, go for butterflies. Yeah, I mean, you can calendar this up. You can butterfly it. You can simply do debit spreads. There are all types of things that you can do. With the options to say, well, I want to take advantage of upside or downside here. Okay. For me, for a straight straddle, for a pure straddle, it doesn't make much sense. It doesn't. The prices just aren't good enough. Okay. Now let's go take some individual stocks. Let's get out of the IWM and the SPY. Let's go take something like Bank of America. All right, which Bank of America has had a very orderly pullback, but Bank of America knows how to move. Obviously, what the Fed does is going to affect Bank of America. You're going to have some sort of movement there. Let's see what type of movement we have to get for a straddle to be effective here. Okay. Now, with this, we need to take into account that Bank of America isn't trading right at the strike price. So, we're going to pay more for the calls because the calls are in the money than we are for the puts because of the puts are out of the money. Okay. But all in all, we could get into this trade for about 40 cents on the December 15 straddle, for about 40 cents. So theoretically, and it won't work that just quite that way, because of how we have the discrepancy in prices. But theoretically, we need a 40-cent move in Bank of America. Can we have a 40-cent move in Bank of America? Sure. That seems a little bit more realistic than expecting a 57-point move in the S&P 500. Okay. At the same time, though, if I really wanted to set this up to have real upside and downside at the same level, we need to look kind of like at the December 15 calls and the December 15 and a half puts. Okay, that way we're kind of in the money on an equal base on both of them. Okay, what's the price on those? 36 cents and 36 cents. So we need about a 60 to 65 cent move. No, it's just a little tough to imagine a 65-cent move. Can it happen? Sure, it can, but very difficult to expect that. FedEx. FedEx has earnings, right? I mean, they have earnings in the morning, and we have the Fed, right? One of you referred to it as a double whammy yesterday, right? So here's FedEx. What would it take to do a straddle? Just looking at the 139 strike, this is going to cost us $6.20 to get in. We need a $6.20 move in FedEx. Can that happen? Sure. I feel more comfortable with playing for a $6 move in FedEx than I would for a $50 move in the market. Okay. Overall. So, yeah, can you go into some individual stocks? Can you take something like General Electric and go and straddle General Electric instead of trying to straddle the market itself? General Electric, you put a straddle on for 50 cents here. Can General Electric move 50 cents on the Fed? Absolutely. I mean, General Electric can move 50 cents on any given day. So if there's a catalyst to see this move 50 cents or more, is much more easy to imagine, or much easier to imagine than a 57-point move on the S&P 500. Okay, so General Electric, that's kind of what would be my kind of favorite play for a straddle out there. If you're looking for a straddle, it's still not juicy enough for me to really want to go after. Okay, Chris. Yeah, Oracle for a straddle, right? Oracle can move on earnings, right? I mean, we saw an earnings gap back here. Let me verify if earnings are in the morning or afternoon real quick here. Oops. Let me go back here. Okay. So we have Oracle after the market tomorrow. Okay. So we have the Fed and then Oracle afterwards. Um, what do we have? What type of movement do we have to get for Oracle to pay off? Well, if we're doing the 33 strike, 33 is going for $1.10. We could do the 33 and a half. That's kind of where the stock is. We pay 80 cents for the calls, 80 cents for the puts, about $1.60 for that straddle. Can Oracle move $1.60? Well, $1.60 is breaking down below 32 and breaking up above 35. Okay, can it do that? Sure. It has done that in the past. October earnings, it didn't do that, or September earnings didn't do that. We didn't see that type of movement back here in September. We did see that back here in June. But your danger there is you're paying $1.60 for that. If Oracle goes up 50 cents, if Oracle goes down $1, you're going to lose on your calls and your puts. And yes, you will have a huge volatility crush. It will take that premium out, and you wake up and Oracle is flat. You're going to see your 80-cent call now worth 40 cents and your 80-cent put now worth 40 cents. Where you just see a huge crush on both sides. So, straddles always sound good in theory. You say, well, it doesn't matter which way the stock's going to go, I'm going to make money. But you need it to go enough. You need it to move enough in order to capture that. Overall, as I've gone out and priced various straddles out there, I don't like the pricing. I absolutely don't like the pricing. I don't think they're priced very cheaply ahead of the Fed. Now, does that mean maybe the market's expecting a little bit more movement than I am? Maybe. Okay, maybe. But overall, I'm not a huge fan of some of the straddle setups. Okay. Yeah, Max, risk reward's rarely good in a straddle. You're correct. Take something like Verizon, which has been moving, right? I mean, it's been moving. Good chance of it moving after the Fed, right? Interest rate sensitive. Let's go look at the price on these. The 47 and a halves. It cost us about 90 cents here for the 47 and a halves. Can Verizon move 90 cents? Well, yeah. I mean, it's moved that just in the last little bit. I'd rather bet on like an individual stock like Verizon moving $1 or 90 cents than I would for the broader market to move, 57 points here. Okay. Okay. Alrighty. So anyway, that's kind of my take there on the straddles ahead of the Fed here, and with what's going on there. Okay. Yeah. Let me do something. Bear with me just 1 second here. Let me go open up a paper account. Okay, I'm not going to do this live. Let me go open a paper account. There's no better way to learn, some of the spread strategies and whatnot than to just do them. On paper, see, okay, would it work, would it not? How do the options really move? So yeah, let's go set one up. Let's go set one on Facebook. We'll go set one on Twitter. We'll go set one on the market. We'll come back. We'll review them after after the Fed. We'll set up just a bunch of straddles here and go and play with those. Let me get the screen here so that everyone's able to see it here. Okay. There we go. Okay, let's go Twitter. Okay, well, let's start with the market itself. Okay, let's take the S&P 500. Okay, and let's go set up a straddle here. at the 178 strike, or excuse me, the 178 and a half strike here. Let's see here. You'll notice calls and puts are very differently priced. Because of that, I'm going to go after the 178. Now, on Thinkorswim, you can actually come in, or most brokers, you can actually come in and say, hey, buy me a straddle. And you can choose which one you want. So you can say, well, I want the 178 strike. Okay, so it'll buy you a call and a put here. Instead of doing that, I'm just going to do the singles. So I'm going to go buy a 178 call. Let's go buy 10 of those. Okay, this is a paper account, so I am going to use a market order. Okay, again, these are not live trades. We're just setting up a straddle here on the SPY. Okay, ahead of the Fed. Okay. Okay. We're just doing a straddle here. Okay, on the SPY. Okay. So now, if we come into monitor and to kind of take a look at these, it's still working the orders, still trying to fill them. Different paper accounts will react differently, but it's not showing those orders filled yet. Okay. Let's go set one up here on let's go set one up here on Twitter. Okay, here's Twitter. If we come into Twitter, we're looking at Twitter. Let's go with the December 55s and a halves. Okay, 55 and a halves. So what I'm going to do is I'm going to come in. I'll do it with the straddle. Okay, at the 55 and a half. Basically going to cost about $3. It puts my buy of the call, buy of the put, both of those orders down here below. Again, I'm just going to do a market order because this is a paper account. Okay, and we're into a Twitter straddle. So in order for that to pay off, we need Twitter to move over $3 by Friday. Okay, for that trade to pay off. Let's go do it with Facebook here. Okay, and let's just set up a straddle on Facebook here at let's just go with the 54 strike. Okay, so I now have a Facebook straddle in play. Okay, and as these fill, I'll probably have to log off and log back on for those to fill. But as they fill, we'll watch those over the coming days here. Okay. If you're doing them live, you can split spreads and put limit orders and different things like that there. Okay. All right, let me see here. If you want to straddle earnings, you have to find stocks that gap heavily. Some stocks are Netflix, Google, GMCR. No, absolutely. And one of the things on earnings, you can often do a strangle. The only difference with a strangle is with a strangle, you're buying, let's say, the 54 call and the 53 put. So a strangle, technically, you're just using different strike prices for the call and the put, and so you're expecting, you're expecting a move. You're actually going to get a better payoff if the stock goes up than goes down, but if it does go down, your loss isn't going to be as great. Are there any disadvantages in selecting straddle rather than single when doing the order? It depends on your broker, Jonathan. Good question. Different brokers will do it differently. Most brokers, there's no difference. They're going to charge you for the call entry. They're going to charge you for the put entry, and just like if you had done it singly. Okay. Sometimes if you do a joint order, it is a little tougher to get it filled, but not generally. Okay, as long as you have a reasonable price or reasonable spreads in there. Okay. I generally just I generally will just go with the single orders. Okay, the single orders there. Okay. All right, so those are some of the things that you can play the straddles with, and to kind of go with on those different things. I don't really like the pricing on them. Don't really like the pricing on them overall here. Okay. Wick, you make a good point. It doesn't have to make the full move because there will be value in the other side still. Yeah, occasionally. But one of the things that will happen, one of the things that tends to happen, let's go to the SPY straddle, right? One of the things that will happen is after an event, some of the implied volatility will actually come out. So if you don't have a big enough move, you can actually lose money on both sides, even on a partial move. So yes, there will be value in the other side, but sometimes that value doesn't hold up as well if there's a little bit of an IV crush. Now, something like Verizon, something like Facebook, you're probably not going to see a huge implied volatility crush after the Fed overall. Okay. Yeah, no, good point. Yeah, some of the things that can happen with a straddle, I know this is one of the things Carl likes about it is, you start to get a gain on one side, you can pull that off and hold the other side. One of the things that's appealing about playing a straddle is, once you get, so let's say you have the call and the put. Once you, let's say your stock goes up, once you get 100% profit on the call, you pull that call off. Now you've pulled all your money out of the trade. And hey, if the stock goes down, that put value comes back for you and makes you money. A home run. You have nothing to lose. And so you kind of have a free lottery ticket, essentially, there with the option. Okay. And that's what some people like about those. Okay. Alrighty, I'm gonna go back here, take a look here at Halliburton and EMC. Halliburton's had another little bit of a push lower here, down about 55 cents. Not a great start here. For the trade overall. It's not in a entirely bearish position. But not a great start for it. We will wait till the close to kind of hold off on that. EMC is coming down into the support. 2340, 2350, kind of the support area. Both of these are being kind of brought down with the broader market overall here today. Again, with the Fed on tap, but don't really want to make any decisions midday. We'll tend to get a little bit of movement near the end of the day, and we'll reevaluate them at that time. But overall, there's really nothing to react to. And bottom line is, if they do force us out, right? I mean, they're not going to be such losses that blow us out of the challenge. They're still, we're still from a challenge standpoint, and one of the reasons we went with the trades the way we did is knowing, hey, you know what, they're not going to blow us out of the water if they don't work, and ahead of the Fed and with the Fed, we know there's some extra variability there. Okay. Yeah, do you still write a blog? If yes, can we read it? No, in fact, I share my thoughts here on Trader Minute here via video, as far as, the different things that I share. That blog that I guess we had been talking about a little bit this morning was something that we did to kind of gauge interest for doing a challenge for a Trader Minute platform, and because at first I didn't think anybody really had much interest in it, and we were surprised at the interest for that. So we went with that. Obviously, we still have different things coming and different things happening and coming along. As we go forward, you'll see some changes into the new year, where you'll see a little bit more writing from me. Won't necessarily be called a blog, but where I'll have some more written type thoughts, where some of the things that I have in my journal, I'll be putting on the site. We'll also have kind of a Trader Minute lab where we'll be doing some back testing and futures probabilities and stuff like that with Vibe and Trend Rider. So, can you call all this a blog? Sure, but I'm kind of sharing it in this format where it's via video and my thoughts are shared, more in the verbal thought. Okay. Yeah, Max. What I thought people would not be interested in making 100K from 3K. No, I mean, look, I know people be interested in that, right? I mean, that's kind of a no-brainer. To me, could people accept that? Hey, occasionally, the 3K doesn't work. I mean, we lose our 3K, and is that something that, okay? Yeah, it's one thing when everything works. It's another thing when it's going through a period like where it is now, where it's just kind of treading water or not working. Do people have any interest to stay on for any little period of time and have any patience with the general concept? And we found that there are many of you that do. I know there are some that are on and say, you know what, I'm just here. If it works, then great. If not, then I'm out right away. But that's fine. And in that we use that blog to kind of gauge the overall interest there. Okay. Alrighty. Well, so again, Halliburton EMC, no changes right here. They're both in positions where they're needing to kind of start to bounce here sooner than later. One of the things, if you take a look at kind of a minute chart here on Halliburton, take a look at the volumes relative to yesterday, very light. They have started to build in the last 30, 40 minutes down here around this 49.60 area. EMC volumes have been relatively light all day. There was a little bit more in the morning, but overall, volumes have just been non-existent here, and this is the norm. I mean, if you take a look at stocks, take a look at some of the bullish stocks from yesterday, things that went up deer, right? I mean, pulling back on light volume, you can't. If you're in deer calls here, you can't look at today and say, "Oh, I got to get out of my calls. Something major is happening. A big shift. This is drastic." IBM, same type of thing. IBM big volume update today, light volume pullback. These tend to end up actually being buy opportunities more than sell opportunities. But at the same time, you still have stocks that are continuing some of their downward momentum, downward trends. The Hershey's, the Verizons, the Colgates, and some of the staples and utilities that are out there. Alrighty, well, thanks for hopping on. Any other questions? Please let me know. I'll be on chat here with you. Also, tomorrow morning we'll go out. We'll start looking at. I mentioned that we'll set up um, some trades, some auto trades for some of the volatility with the market that could come in. Where we'll set up some automatic trades. We'll do that with you here tomorrow, and again, they won't be kind of a challenge trades or anything like that, but just show you how those things work. Okay. Yeah, Sheila, really good question. When you say options are expensive, is that because the bid-ask spread, at least part of the time? Yeah, sometimes, Sheila. Yeah, sometimes. Let's take a look here at the SPY, right? Let's come in here to the SPY, and I say that okay, these options are relatively expensive if we're doing a straddle. That's just simply because of the cost. If you look at the bid ask spread, it's really small, okay? But you can have a bid ask spread that's relatively small. Take a look at FedEx here. I mean, FedEx, the spread isn't real big here. The spread's actually really, really good, but you're paying a lot of money for these options relative to what you would pay 3 weeks ago or 3 weeks from now. Why? Because the implied volatility is going up. Basically, people are expecting news out of FedEx. They think that news is going to move the stock. And so the options, both the call and the put prices, go up because of that potential heavy move in the stock price. Okay, so in all, that's kind of when we say they're expensive. Most of the time, it's because of the implied volatility. Because hey, maybe this should be worth about $2.40, and it's now worth $3. Sometimes because of the spread. Something like Vulcan Materials here. right? If you want to buy a call on this, you're paying $7 for something that you could only sell for 5.90 right there. That's also expensive. That's a big hit to take right off the bat, just because of the spread. Okay. Yeah. So is that a good time to sell options? Yeah. If that's your strategy, I wouldn't be doing that for a large spread because you're selling at 5.90 and you're buying back at $7, so you still have the spread issue. In a case like FedEx, where the options are expensive ahead of the news, you have to ask yourself, do you want to sell that option? Because if you sell that option, you're taking on an obligation. If we go and sell a 140 call, we basically have to turn around and sell this stock to somebody at $140. So if FedEx earnings come out, if FedEx jumps up to $150, and now we're sitting here having to sell it to somebody because we're contractually obligated. Now we have to sell it to them at 140, and we're going out and buying it for 150. We're taking a big loss there. So just because an option's expensive doesn't mean it's a good time to sell the options. And just because they're inexpensive doesn't mean they're not good to sell. It really comes down to your strategy and what you expect from a movement in the stock price. Okay, what your expectation is there. If you're looking at FedEx and you're thinking to yourself, you know what, FedEx is a really good stock. If they get taken down on earnings and they go down to 133, I want to be a buyer at 133. Well, okay. Instead of waiting for it to go to 133, you can come in and sell some puts. If FedEx goes below 133, you'll have to buy the stock at 133, which is where you wanted to buy it anyway. And if FedEx goes up, you're at least capturing the dollar in premium here. Okay, the dollar in premium. So it really kind of depends on your option there and on your strategy overall and what you're looking for. Okay. Alrighty. Well, thanks for hopping on. Any other questions? Let me know. I'll be on chat, and we'll talk to you soon. Take care.